Joining me now is Brian Reynolds. He is Reynolds Strategy Chief Market Strategist. It's great to see you again, Brian. Welcome.
Thanks, Kelly.
What is flashing some concern for you? Because normally I go to you to be reminded of the importance and strength and presence of buybacks, but not right now.
Well, this is a really complex investment environment, probably the most complex environment of most people's lifetimes. And the buybacks have been the biggest pillar of stock prices in the last year or so. But that's been offset somewhat by retail investors slowing and institutional investors becoming very, very bearish. I think we may be nearing a point where stocks in general start to go up because of the buybacks. And if that happens, there's going to be a lot of disbelief on Wall Street. And that's the type of environment where institutions sell the names buying back the most stocks. S&P has an index, the buyback index, and it's losing momentum now. And I think in the fall, it could start to underperform. And I think it makes sense to sell into strength now with an idea of buying on weakness this winter.
Has there been any change in the pace of corporate buybacks?
They've been setting records. The fourth quarter and the first quarter numbers each hit a record. They may have pulled back a little bit in the second quarter, but the reason why stocks are down is because the selling from institutions has overwhelmed those buybacks. I don't think that selling can go on forever. I think we're in some type of a multi-month bottoming process. If stocks get above the S&P 4018 area, I think that's an area of significant resistance. Then I think that starts at least a large bounce up in the fall. And again, I think people will fight that and probably sell the buyback names.
Yeah, so why do you think this could get worse before it gets better? And I'm specifically talking about the underperformance of these big buyback names.
Well, they've actually outperformed this year in the downturn. So if we do get a rise in general stock prices, I would expect them to lag, again, because people just don't believe the buybacks are going to persist. There's so much negativity out there. Bank of America's monthly survey showed that sentiment is at the worst levels in at least 20 years in the institutional side of the business, even worse than it was in 2008. But the credit market's still providing money for buybacks. In the first 2 days of this week, investors bought almost $40 billion of new corporate bonds. Much of that money is going to go to buybacks.
Wow.
It just won't probably be reflected in the stock's names because people will take that money and distribute it elsewhere.
That is so interesting. And again, so it reminds us that buybacks are still happening. They're still strong. It's just that big money investors are so pessimistic, they're overwhelming that effect and kind of pushing a lot of these names lower. What about retail? You've highlighted the retail presence in this market has been a real thing, almost as important as buybacks. Retail sounds a little more bullish than the institutional side these days. Is that providing any offset?
I would characterize retail as having gone from really hot in 20 and 21 when we last talked about that to more of a neutral this year. Some of the more aggressive retail investors have had to pull in their horns. They've had margin calls, and they're actually, if you look at the options market, it's not as frothy as it was at this time a year ago. On the other hand, traditional retail investors have picked up the pace a little bit by putting money into ETFs. So net, that's probably a neutral right now, where it was a significant positive a year ago. So you've got that split between buybacks, retail, and institutions, and that's why this year has been so difficult to trade.
And the final question I have for you is, what do you think is the biggest difference in this market environment versus 2008 if you don't see the same risks that obviously caused the market to crash last time around?
This is very different from 2008. It's nowhere near as bad. In 2008, I was pointing out about how pension funds, the biggest buyer of credit, were being forced to sell credit with margin by getting margin calls they couldn't meet. Now it's the opposite. As I just pointed out, we did $40 billion in 2 days of new corporate bonds. Today is going to be another large day of issuance where investors are scooping up corporate bonds in a wide variety of industries. That's a big difference. That's the difference between going down for 6 months and then gradually coming back and having a 1.5 to 2 year financial disaster. This is not a disaster.
And institutional investors, if they are listening to you, maybe we'll get less pessimistic and stop pushing these stock prices lower. Brian, thanks for your time today.